So good morning, everyone. I'm Dawn Kinley, the head of the Pension Fund. Great to see so many of you with us this morning at our actuarial valuation meeting. Sorry we've had to ask you to turn your cameras off, but we're just frightened of the bandwidth falling over. So this morning, Neil Smith, our investments manager, is going to provide an update on our investment portfolio and on investment markets. Barry Dodds, our actuary from Hymans Robertson, is going to take you through the 2022 valuation process to date, which will include a summary of the overall results and a very helpful walkthrough of the employee results schedule. So hopefully the majority of you will have received your schedules by now. For those who haven't, they will be with you shortly once any final queries have been resolved. Barry is also going to take you through the main changes to our funding strategy statement. We'll take a short break after Barry's presentation, and then Steve, who heads up our regs and comms team, will provide an update on current matters of interest to the fund and to the LGPS generally. The presenters will pause for questions as we go along. Valuation is a really complex process and there are absolutely no daft questions, so please do shout up. Before we start, Steve is going to take you through a bit of housekeeping for the meeting. We will be sending out feedback forms about this session and I'd be really grateful if you could complete them, because it will really help us when we're planning for future events and for future communications. So thanks, Steve.
Thanks, Dawn. Great to see so many of you here today. So what I'm just going to do is share screens. Just bear with me a second. And hopefully everybody can see that. So I'm just going to go through one or two little protocols. That's just the summary of the day that Dawn's just gone through. So housekeeping. I bet most of you are familiar now with meetings through options like Teams or Zoom, but I'm just going to run through a few things. Firstly, on timings, we aim to finish by about 12 o'clock. We may need to go a little bit over, but hopefully not too much. Please keep your microphones muted and cameras switched off during the meeting unless you're asking a question. Keeping your microphone off helps with trying to minimise background noise, and also keeping your camera off saves bandwidth and may help stop the call falling over. If you wish to comment or ask a question, there are two ways to do this. You can type a question in the chat down the side, which we're monitoring, so we'll pick it up. Please use the chat to comment or ask any questions while the speaker is talking. If we can answer quickly by chat, a reply will be sent. Otherwise, we'll wait for a convenient opportunity for the speaker to answer. If you want to ask a question or make a comment using your microphone, please use the raise hand function. This is the button on the toolbar that looks like a hand icon at the top. Once you've raised your hand, please wait for the chair to ask you to, or one of us to ask you to unmute your microphone and switch your camera on. Once you've spoken, please click the hand icon again to lower your hand, mute yourself and switch your camera back off again. Captions. So one useful thing within your Teams window, you've got the option to be able to switch on live captions. This is really useful if you want to have a bit of additional help in following what's being said. And don't worry about switching it on, it only switches it on for you. Recording, as we've said, the meeting is being recorded today and we'll make it available for all employees that couldn't attend today, or of course you could watch it back yourself if you want to pick something up again. We'll also be sending copies of the slides, so please don't worry about taking copious notes as you'll have the slides very soon. After the meeting, we'll send you a link to a feedback form so you can let us know how helpful the meeting has been. It should only take a few moments to complete and will be really helpful to us. So it'd be really grateful if you could just find a minute or so to submit your feedback. So to start, our investments manager Neil Smith is going to provide an investments update, and then we'll move to Barry from our actuary Hymans Robertson to talk you through the valuation exercise. So Neil, it's over to you.
Okay, thank you, Steve. If you could turn to the first slide, that'd be helpful. Okay, hello everyone. I've been asked to give an overview of the fund's investments for 10 minutes or so, And I thought it'd be useful to start by trying to cast our minds back to the corresponding meeting in 2019. I know it feels a long time ago, but at that stage, we'd had several years of markets gradually grinding ever higher. Whilst there were bumps in the road, the direction was upwards and returns were positive. It'll come as no surprise to anyone that since 2019, so since that markets have been very volatile, starting off with the outbreak of the COVID pandemic in early 2020. And you'll see from the chart, which shows market returns over the period since 2019, that markets initially sold off sharply, but national governments and leading central banks were very quick to intervene in order to protect both the public and businesses through various support packages, such as the furlough scheme in the UK, ultra loose monetary policy by the central banks, and a generally deflationary backdrop. So very supportive. Whilst it differed by sector, this backdrop was very favourable for equity markets, and you can see the two top lines on that chart, which are equity market returns. There were great returns over that period, with sectors such as IT, consumer discretionary, and healthcare generating stellar returns, and they played very well into to the extent you can say that with the COVID pandemic. They benefited from the pandemic. IT did very well. Everyone was working remotely. Companies such as Amazon, consumer staples did very well. People were ordering online, lots and lots of deliveries, and obviously healthcare businesses such as Moderna, who developed vaccines, did very well. That trend continued in 2021 as lockdowns were relaxed and reintroduced as we went through the year, depending on national needs. However, towards the end of 2021, cracks started to appear as economies tried to return back to normal. And what we had was that global supply chains had become extremely challenging, not least caused by China's ongoing zero COVID-19 policy, and they are obviously a key supplier into the global supply chain. And businesses were starting to find it increasingly difficult to recruit staff for whatever reason, with quite a lot of people who had previously been in the workforce not coming back into the workforce. Inflation started to build, and with some hindsight, the leading central banks were too slow to raise rates, which has also added to the inflationary backdrop. This meant that when central banks did start to raise rates over the last 6 months, those increases have been very reactive and very sharp. So also the economic backdrop was not helped by Russia's decision to invade the Ukraine in early 2020. This further hindered global supply chains, and energy security, or the lack of it, intensified, particularly in Europe. Energy prices increased sharply, pushing up inflation further and leading to the cost of living crisis narrative that we are seeing both in the UK and globally at the moment. What is interesting to note is that I talked about those sectors' equity returns during the first 12 months of the COVID-19 pandemic, and the sectors that did very well. It's interesting to note that those sectors that underperformed during the first 12 months of the COVID-19 pandemic, such as oil and gas, basic materials and industrials, they've actually rallied strongly over the last 12 months. So they performed really strongly. Conversely, those sectors that performed strongly in 2020, IT, consumer discretionary and healthcare, have lagged. And that goes to demonstrate the importance of maintaining a diversified portfolio and having exposure to all sectors, such that when one sector is performing well and one sector isn't, you get a smoothing of those performance returns. And those relative sector performances in many ways are driven by what's happening to interest rates. Some sectors, particularly those IT, benefit from a very low rate interest environment, whereas when rates start to build, those businesses, because the growth businesses, they're making acquisitions funded through debt, start to suffer because it has a big impact on their growth potential. So whilst there are some signs that inflation may now be peaking, and you'll have seen that over the last week or so, US inflation appears to have peaked and is starting to come down, and the UK's inflation announcement yesterday indicated a small decline. Rates are still very high, and economic activity is now slowing, and there appears to be a consensus view that we'll see a global recession in 2023, albeit the severity of that recession will differ by geographical region. The general view, and I'm not an economist, is that the US will see a recession, but it will be quite a shallow recession, whereas Europe, because of the impact of higher energy prices and energy security, is likely to see a deeper and more prolonged recession. I'll come back to current considerations for the pension fund later in this presentation. So if we could turn to the next slide, Steve. Steve?
Yeah, I'm just trying to move it, Neil. It's just stopped working for me.
Fine.
Bear with me.
Okay.
Got a technical hitch. Not sure why it's not working.
Do you want me to share my screen?
There we are.
Okay, thank you. Lovely. Okay, so this slide shows the investment assets of the pension fund over the period that we've been talking about. And as mentioned, that whilst the economic backdrop has been challenging, over the last 3 years, overall returns generated by the fund have been positive. And it can be seen that the fund's investment assets have increased quite strongly over that period. So they've gone from 4.9 billion in March 19 to 6.1 billion in March 22. So that's quite strong growth, and we will touch on the investment returns on a later slide. And it's interesting, or it's worth noting, that March 22 valuation point was the valuation used for the actuarial valuation. So that will have fed into the funding levels that you're seeing and the forward employer rates that that should be coming through. So if we could turn to the next slide, Steve. So what this slide shows is the asset allocation of the pension fund. So the fund, in line with standard industry practice, invests into a widely diversified range of asset classes, and that's designed to reduce volatility and risk and hopefully smooths out investment returns. And it's also designed to generate a return in line with that used in the actuarial valuation. I'm not going to go through each asset class in detail in the time that we've got available, but wanted to flag that the fund's strategic asset allocation benchmark, so the SAP, was updated in 2020, so within the date range that we're looking at. That followed a public consultation on the proposed changes to that strategic asset allocation benchmark and the investment strategy of the fund, and was approved by the Pensions and Investment Committee. The key change was that several of the fund's previous regional equity allocations, so North American equities, European equities, and Asia Pac equities, were effectively wrapped up into one allocation, which is called Global Sustainable Equities. So what that allocation is designed to do, it's designed to provide the fund with a global exposure to long-term sustainable businesses and reduce the fund's carbon footprint. And I'll mention climate strategy later, because I know it is a topic of interest to people. The portfolio is highly diversified and contains many of the companies which were previously part of the regional allocation. So whilst it looks like quite a significant change, with several regional allocations being taken away and one big allocation, it invests in many ways into exactly the same companies, but it's looking in particular for long-term sustainable businesses and to reduce carbon footprint. But many of the stocks are the same, so it looks big, but it's not as big as it potentially does look. Next slide, Steve. Okay, so everything I've covered so far, what does it mean in terms of the fund's actual investment returns? And this slide shows the fund's annualized investment return after all costs relative to the benchmark. The good news is that investment returns to March 22 were positive, and actually over the 3 years to March 22, the fund generated an annualized investment return of 7.4%, which is 50 basis points higher than the benchmark. It's also worth noting that the fund's return over the period is higher than the return which was assumed in the 2019 valuation for actuarial purposes. And as Imans will discuss later in this presentation, this has helped to increase the fund's funding position at March 22 and is a driver of that. I think it's important to note that whilst that looks very positive, and it has been very positive over that period with really healthy returns of 7.4%, it's not all been plain sailing. And as I've alluded to, markets have been more challenging of late as we go into a potential global economic recession. So whilst we as a fund have continued to outperform our benchmark, it's worth noting that on a year-to-date basis, so since March 22 to November 20, the fund has generated a return of about -5%. So equity markets have fallen generally, bond yields have risen, so it's negative at the moment. We're in very much in an environment over the last 6 to 8 months where the majority of investment returns by asset class are negative, and we kind of can't beat that trend. We can try and do better than the benchmark, but we can't buck that trend. If markets are falling, that flows through to our investment returns. Next slide, Steve. So current considerations. So this slide sets out some of the current considerations that we have to take into account. Now, it's impossible to say what will happen over the next few years or what market returns will be. We don't have a crystal ball and nothing can be guaranteed. However, we know that there will be bumps in the road, but we are a long-term investor and the majority of scheme employers are in the fund for the long term. So therefore, we take a very long-term view on the investments that the fund makes. If I was a betting man, which I'm not, I think that markets will remain very volatile in the short term, with markets very much focused on the economic backdrop, what happens in 2023, how deep are those recessions, where are we on inflation? Is inflation starting to fall? Is it starting to get back to the target rates which the central bank set? And that will be particularly driven by the US Federal Reserve, which will be the key measure of what is happening on inflation and interest rates. A lot is driven by what happens in the US, and also how the Federal Reserve responds to that. That said, my view is that the recent market weakness means that asset values, which had become very stretched coming into 2022, are now more attractive than they were coming into the year. So that does actually present a buying opportunity for a long-term investor such as a pension fund, but there will be volatility and not all asset classes will perform the same. So there'll be volatility, and stock selection and asset class selection will be key. Next slide, please, Steve. So I mentioned climate change because obviously it is very much a key topic and one that we get quite a few questions and queries on. So we try to take a very proactive approach in managing climate change risks and opportunities. So we actually developed a climate strategy in 2020, and that was published in 2020 following a public consultation and approval by our Pensions and Investment Committee. In summary, that climate strategy, it's a fairly lengthy document, but in summary, we support the aims of the Paris Agreement, and we're aiming to have a portfolio of assets with net zero emissions by 2050. To support that ambition, the fund has set initial decarbonisation targets together with targets around the level of sustainable and low investment that it makes, so investments into renewable energy assets and things like that. These targets will be increased over time to support the 2050 net zero emissions target. So we're not aiming to do everything in the next 5 years. It will be a journey. So it will take time. It's also worth flagging that we do actually produce an annual task force for climate related financial disclosures called TCFD for short report, which is a best practice report that you should produce. And what that does is on an annual basis, it sets out how we manage climate change related risks and opportunities. And it also sets out what the carbon metrics are of the fund on those assets that you can measure at the moment, because you can't measure the carbon footprint on all assets, but you can measure your carbon footprint on things like listed equities and your listed corporate bonds. And it also sets out how we're progressing against those targets that we set, and are we achieving those targets? And I'm pleased to say at the moment we are achieving those targets. So we've set those initial targets and we are delivering those targets, and those targets will build over time. But we do believe that it's still really important to have a highly diversified portfolio, because as you'll have seen from what's happened in markets over the last 3 years, sector performance can vary significantly from 1 year to the next, and making sure you've got exposure to sectors and all sectors is really important. So that was all I was going to cover at this stage. I welcome any questions, and hopefully that's been useful.
Thank you. Thanks very much, Neil. Have we got any questions from anybody? Steve, can you see any? I'm not sure if I'd be able to see them on this screen.
No, there are no questions, no hands up, Dawn, that I can see at the moment. So.
Okay, well, thanks very much, Neil. As Neil has
Okay.
suggested, that's really demonstrated the heavy lifting that the assets have done over the last 3 years. We're not really expecting that to happen over the next 3 years, but we'll see. But thanks very much, Neil. That was really helpful.
Okay, thank you very much.
So can I pass over to you now, Barry, please? Barry Dodds is from Hymans Robertson, is our actuary.
Yep, hello everyone.
Thanks very much.
I'll just try and share my screen so that you can see my slides. Okay. Hopefully you can see those now. I will say, and I know Steve pointed out at the beginning, thanks Don. I know Steve pointed out at the beginning, do feel free to stick your digital hand up and ask questions as I go. I'm working off one screen at the moment, so somebody will hopefully let me know that somebody's got their hand up, and I can stop and answer the question as we go through, or indeed happy to answer questions at the end. So just to introduce myself, I'm Barry Dodds. I work for Hymans Robertson, who are the fund actuary for your fund. And the presentation today is basically all about the 2022 valuation and a couple of things that kind of sit alongside that. As Don mentioned earlier, the funding strategy statement's an important part of the valuation as well, and so I will kind of take you through a bit of background on what the funding strategy statement is as well, and the changes that we've made to that document this time around. Some of you may have been involved at previous valuations if you've been involved with the fund for more than 3 years. And so it's some of this should hopefully be bringing back some memories, but for those of you who are new, hopefully I can kind of cover the basics well enough to make sure you know what's going on in general and how the valuation proceeds. So what will I cover today? A bit of background to the 2022 valuation. I'll go through a little bit of detail about kind of what data we use and what assumptions we've made, and how we actually do the calculations. I'm not going to a massive amount of technical detail because obviously that's not what anyone wants to hear for the next hour. But I will give you a kind of high level background on how the calculations are done. I'll then get on to what you're probably a bit more interested in, which is the output, so the valuation results themselves and kind of what those mean for you as employers. And I'll take you through, as Don mentioned earlier, I'll take you through how your employee results schedule looks, and kind of take you through each bit to show you that what each bit is for, and explain it a bit more, so hopefully it gives you a bit of a better understanding of what's in that document. Now, hopefully most of you will have received your employee results schedule by now. There are still some that are, there's some kind of ongoing work being done on them, so don't worry too much if you've not received yours yet. You will be getting it in the near future, but hopefully the majority of you should have received your schedules already. And then the last thing I'm going to talk about is the funding strategy statement, which is what I mentioned earlier, and I'll go into a bit more detail about that later. So we'll start off with a bit of background to the valuation itself. This slide is very much the basics, and apologies if it's offending anybody in terms of their intelligence about how the fund works. Certainly, if you've been involved with the fund for a while, you should be aware that this is how it operates at a very high level. So the fund collects money in from the employers, and that's both employer contributions and employee contributions that come in on a monthly basis. That money gets invested, so there is an actual pot of assets sitting there that Neil's just kind of been talking about in terms of how that's invested by the fund and in what different assets the money goes into. And the idea obviously behind that is that money grows in value in the long term, and that is used to, obviously, that investment return is used to help cover the cost of the benefits. And then at the other end, what's happening is, well, it's really the main purpose of the fund is paying money out to members in terms of pension benefits and indeed lump sums when members retire as well. So contributions and investment returns are essentially what's used to fund all the benefits. Now, a key funding decision as we go through the kind of valuation is where we strike the balance between the kind of contribution rates that are being paid in and the investment returns that are being earned on the assets. So we have to make an assumption about how much we're going to earn in investment returns on the assets that the fund has. And so it's where do we strike the balance between what we assume we're going to earn on investment returns and what we can get in from contribution rates from employers. Now, this chart shows what we call the liabilities on the left-hand side, but basically that's just the kind of the benefits, largely the pension benefits earned by members in the fund, by your members that you employ, and indeed the members that you have employed in the past who have since left and either are still to take their pension benefits or are already taking their pension benefits. So the kind of bottom left box there that says benefits earned to date, that is essentially what we call the past service benefits. So when we do the valuation, we say at the 31st of March this year, 2022, how much has been earned in benefits by all the members in the fund. And that's what we call the past service liability. And what we do to create what we call the funding level is we say, how does that compare to the assets that we've got sitting there at the moment at the same date? And basically the assets divided by the liabilities is your funding level. Now, what we also have to bear in mind is that there are going to be benefits earned in the future. There's additional benefits earned every day by the members, and so we have to take those into account. And when we're doing our calculations for how much in the way of contributions we think needs to be paid in, that's a big factor, because largely the contributions you pay in are the vast majority of your contribution is to cover future benefits that are being earned. So we do, when we're doing the contribution rate calculations, they are largely focused on that that future service and benefits that are going to be earned after the valuation date. So basically the kind of theme here is, main takeaway from this slide is that the funding level focuses on the benefits that have been earned up until now, and we do allow the vast majority of your contributions that you pay in is actually to cover the benefits that are going to be earned in the future. So why do we do evaluation? The main kind of output is the employer contribution rates. That's one of the main focuses of the valuation, is to work out how much is appropriate for each employer to pay into the fund. We also have to do it because we have to comply with legislation, which says we have to do it every 3 years. And so that's a very good reason to do it. And it's also a very useful time to analyse what has happened over the last 3 years against what we assumed what was going to happen at the last valuation. So it's a good kind of retrospective look at the experience of the fund against what we assumed would happen. It's also an opportunity to review the funding strategy statement, and I'll come to that a bit later on. And it's a good kind of health check on the fund solvency. So how good is the funding level now compared to what it was 3 years ago? Oh, excuse me, I think I've just managed to stop sharing there. I'll try and get that going again. There we go. Hopefully that's it back up now. So how do we do the valuation? On the left-hand side here, we've got a bit of background as to what information we use to do the calculations. So we get data for each member from Dawn and her team, who look after all the membership data. And so that's for all the tens of thousands of members that are in the fund. We get a kind of line of data for each one of them, containing many bits of information, but that we require in order to try and project what benefits they might get when they retire. We also have to make assumptions. As I mentioned earlier, what we're doing is projecting what benefits may be paid out decades into the future. So we have to make assumptions about what might happen in financial markets, and also what might happen in terms of things such as life expectancy and when people retire, and in what kind of health people retire, if they retire in ill health or normal health. So those ones are what we call demographic assumptions. So kind of life expectancy is the main one, because obviously the longer a benefit is paid for, the more it's going to cost. So the longer somebody lives, the more it will cost. So we make quite a few assumptions, which I'll cover shortly, about exactly how that all pans out. But we also have a kind of funding and investment strategy that we have to take into account. How are we funding for each employer's share of the fund? How do we do that? And indeed, what is the fund invested in? We need to make sure we're consistent in our assumptions between what the fund's actually investing in and what we're assuming the returns are going to be. And then we obviously have to bear in mind the LGPS benefit structure itself. So the benefits that are earned by all the members are set out in LGPS regulations. So we obviously have to use those to value the benefits. Now you've got a delightful picture of me in the middle there, back in my slightly younger days when I had a bit more hair. That is the kind of the factory in Glasgow at the moment where we do all the calculations. So we are busy taking all that information, churning it through to give calculations to work out the funding levels for each employer. So it's all done at employer level. So whilst we do, and I'll come to that shortly, we do show the whole funding level, we also have to delve down and look at each individual employer and say, what's your funding level and what's the appropriate contribution rate for you to be paying in to make sure that you've got enough money to cover the benefits that are payable to your members. So we've kind of been in the process of doing that for the past few months, and that kind of getting to the end of that stage where we're getting to the right hand side here, where we're producing the individual employer results schedules, which I'll cover a kind of sample one later on to give you a bit more background as to what each bit is talking about. And the updated funding strategy statement, which is out for consultation at the moment with you as employers. And then there'll be a final valuation report which covers the whole funding position and all the detail around the assumptions and the decisions that were made throughout the process. And that will be signed off at during March. It has to, as by legislation, be signed off by the end of March next year. So we get 1 year to do the valuation. So the valuation timetable here, I'll not dwell too long on this. It's got quite a lot of detail about the different stages of the valuation, but basically it's just to highlight that the valuation work starts before the valuation date, because we do a lot of kind of planning, and Dawn and our team do data cleansing to make sure that the data that they provide to us is as clean and up to date as possible. That then gets submitted to us. We review what assumptions might be appropriate, and then we've done some modelling on contribution rates for the longer term kind of stable employers, so the councils and similar employers. And then we've had discussions with officers about all those results. And then the kind of blue box there is where we're at just now, really. So the employer results are being issued to employers. We're having this employer forum, and there's the consultation period on the funding strategy statement, which is going on at the moment as well. So the next steps are kind of finalising that funding strategy statement and all the contribution rates. Oh, Dawn, I see you popped up. Does that mean there's a question?
No, it was only to, before we go into the next section, if we can just pause and see if there are any questions. Don't want to interrupt your flow, sorry.
No, that's fine. So yeah, so the last thing we do is kind of sign off the valuation report by the end of March, as I mentioned earlier, and your new employer contribution rates start to be paid as of the 1st of April. So that's a good point to stop if anyone has any questions on that.
I think that emphasis is really helpful about the majority of the contribution rate going for the future service, because I think that's really hard for us to explain sometimes if people see an improvement in their funding levels and we're still suggesting that there needs to be an increase in contributions. So that's a very helpful emphasis. Thank you. Yeah,
so I mean, broadly speaking, about 85 to 90% of the contributions that come into the fund are actually to cover future service, not anything to do with your funding level. Because if you've got enough money there, if you're kind of 100% funded on what you've got already, then there's still the cost of the new benefits to cover.
Yeah, I think that's really helpful. Have we got any questions, Steve? Can you see any?
Can't see any, Dawn, at all, I'm afraid. No.
Okay, no, that's fine. Nope. Yep. Okay. Thanks, Barry.
Don't be shy. As Steve mentioned, it's there are no stupid questions. It's quite a technical subject, as Dawn mentioned. So do feel free to ask something, even if you think it's a silly question.
Thank you.
So the next section is about going to a bit of background about what I've described as the inputs here. So the data, the assumptions, and the methodology that we use to do the calculations. This chart, there's a couple of sides to this chart. The left-hand side basically shows the number of members and in which kind of category they are. So the green bits on the left-hand side are employee members, so active kind of participating employees. The blue bits are what we call deferred members. So that's members who have earned benefits while they were employed, but have since left employment and but haven't yet started to take their benefits. So somebody who's maybe left but hasn't reached retirement age, but still has an entitlement to the pension that they earned while they were working. And then the kind of orange bars at the top there on the left hand side are the pensioner members, and that's purely kind of number of members. So as you can see, there's been a kind of rise in each of those over the past 3 years, which is not fairly typical, to be honest, of similar funds around the country. And then the right hand side shows payroll, so that's those employee members, how much is their kind of salaries, and that's gone up a bit since the last valuation 3 years ago, as you might expect, with people getting pay rises, but also new active members coming in to actually add to that as well. And then you have the kind of, I'm not sure what colour to call that in the bottom right, the kind of, I don't know, light orange or something, peach maybe, pensions in payment there. So that's for those pensioners, how much pensions are actually being paid out of the fund each year, which you'll see has gone up from about 131 million to 153 million over the 3 years. Again, you would expect that, given there's been inflationary increases applied to those pensions over the 3 years, and so that's not unusual. But yes, high quality data from Don and our team, which is very helpful from our point of view. Now, the assumptions, why do we need assumptions? As I kind of touched on earlier, because we're projecting benefits decades into the future, we need to make assumptions about various different things. We've shown a few of them here. This chart's basically supposed to kind of show a kind of sample of what one member's journey might look like through the fund. So you got the kind of evaluation date there. This is an active member, so they're not yet retired. So there's a bit of time between the valuation date and retirement. But when they reach retirement age, and indeed that retirement age itself, we have to make an assumption about whether they retire early, whether they retire in ill health or good health, and so on. So that's one assumption. At retirement, most people take a lump sum, but that is kind of optional, and there's people will take different amounts of lump sum depending on what their own circumstances are. So we have to make an assumption about how much that lump sum will be for every member. A pension will then come into payment, and that lump sum and the pension are actually related to salary increases and what we call care revaluation. So that's the benefits that are currently being earned are what we call care, which is career average revalued earnings. So it's not directly linked to their final salary, but is linked to inflation still. So we have to make assumptions about what people's salary growth is going to be, and indeed what the care evaluation is going to be, which is linked to inflation. So we have to make inflation assumptions. So the member's pension comes into payment, and we then have to say, well, how much do we think that's going to increase by over the years? So again, that's a kind of inflationary assumption. And how long do we think it's going to be paid for? So we have to make life expectancy assumptions. We then also have to say, well, how likely do we think that there will be a dependents pension that comes into payment thereafter, and indeed we then have the same kind of assumptions to make around how those will increase and the life expectancy of the dependents as well. So there's, as you can see, there's a lot of assumptions we make. We like to think we're quite good at making those assumptions, but those assumptions are kind of long term that we make. So we look at it over kind of the coming decades and say how do we think things will pan out kind of on average, to make sure that we're using an appropriate assumption and placing an appropriate value on those benefits. So this time around, there's no significant changes in the assumptions since the last valuation, except for inflation. As Neil touched on earlier, the inflationary environment at the moment is very high, and there's varying views, and it's quite uncertain as to how that'll pan out. But generally, the inflation assumptions we're making this time around are higher than they were at the last valuation, and that has an impact because if we're assuming inflation is higher, we're assuming the increases to everybody's pension will be higher, and therefore the cost of that will be higher. So that it does impact on both the funding level, the figures that you'll get, but also and probably more so on the cost of the future benefits, because if we're assuming those future benefits are going to increase more substantially than we were previously expecting, then the cost of those will go up. This is just a wee kind of example slide of that kind of expected inflationary environment compared to what it was at 2019. So the 2019 kind of expectation for inflation is that green dotted line, but the one at this valuation is kind of more in line with that blue line, which is quite volatile and quite high at the moment, but we do anticipate it trending back towards the kind of 2% Bank of England target for CPI inflation over the coming 20 years. So what we do is, as I mentioned, we look over the long term and we use an average. So the average of that green dotted line was 2.3% per annum over that period, and the average of the blue line is 2.7% per annum. Now you might think, well, 2.7% per annum sounds very low considering its inflation sitting at about 10% just now. But as I say, it's a kind of average over what we expect to pan out over the coming years, not just kind of where it's sitting just now. I mentioned life expectancy earlier. We partner with a company called Club Vita, who has millions of lives of data that they use to help us to predict life expectancy, essentially, for all the members within your fund. And they have this data across, I think it's about 2/3 of the LGPS funds data that they have. So they look at the experience of all the membership of those funds, as well as other pension funds within the UK, to try and to initially come up with a observed life expectancy, which is kind of basically just an objective. This is what the data is showing us in terms of life expectancy now, but we also have to make an assumption about what future improvements to life expectancy might be as well. So they help us with that as well. So this kind of chart just gives you a bit of an example of kind of what a kind of stark difference there can be between one person and another in terms of life expectancy from age 65. So if you live in what's deemed a kind of unhealthy lifestyle postcode, so postcode does play quite a big role in this analysis, and it does come through in the data that where you live can have a big impact on your life expectancy. So postcode makes a difference. Affluence level, as you might know, makes a difference. Whether you retire in ill health or in normal health makes a difference, as you might expect. And what type of work you do as well can make a small difference as well there. So you can be at one end of the spectrum having a life expectancy of 13 years from age 65, and at the other end 10 years more. So it's very important to capture that in the assumptions we make, and we do that for your fund specifically, looking at your individual members. Now, moving on from all those assumptions, how do we actually do the calculations? What's the method that we use? Well, for each employer, we have what we call a funding target. And so different employers will have different funding targets depending on their individual circumstances. But basically, that's how much money the fund is aiming for each employer to have. Now, we also use a time horizon, because there's employers in the fund that will be in the fund for decades, like the councils and so on. But there's also employers in the fund that will only be in for a few years. So contractors such as kind of catering companies, cleaning companies that are being outsourced basically often from the council. And so they tend to have short-term contracts, so will only be in the fund for a very short term. So we have that important distinction in terms of a time horizon that we use for each employer. We also have a likelihood of success that we use, so that's kind of how sure do we want to be that the employer meets that target, and that's largely based around kind of how secure that employer is and how we would anticipate them being able to cover any deficit that might come up. So yes, each of these reflects the kind of individual circumstances of each employer, and so that's what we do at kind of employer level. Has anyone got any questions on any of that before I move on? This next bit's slightly technical in terms of how we actually do the calculations, but I'm happy to take any questions before this slide.
I think those inflation charts are really interesting, aren't they? Because I mean, it makes it a great scheme for members, doesn't it? The inflation linking, but a really expensive one for employers.
Yeah, that's the thing. It's and the pensions since 1997 at least, but actually kind of longer in the LGPS. The pensions have had to be inflation linked for that very reason, that it can erode the value of the pension very quickly if you don't do that. But yes, if inflation is high, then yes, it can be quite expensive.
Can't see any hands. Don't think so.
This is quite a kind of scary looking chart, but basically what we do is this is highlighting how we come up with your contribution rates, and we do it kind of on what we call a risk-based approach. So what we do is we project 5,000 different potential future outcomes for each employer. So this is kind of an example of what it might look like for one employer, although you'd have to imagine that there's 5,000 lines there. It doesn't look very good if you put 5,000 lines on there, but it gives you the idea. So we project 5,000 different potential future scenarios over the time horizon that you're going to be in the fund as an employer, and we say how many of those are above the kind of 100% funding level at the end of your time horizon. So how many of those have you achieved kind of 100% funding at the end? And what we do is we set a contribution rate. We do these projections, and we say what contribution rate do we need in order for enough of those to be above 100% that we're happy that it's meeting that likelihood of success. So for example, if we say if we're happy with a kind of meeting that 75% of the time, then we want 75% of those 5,000 lines to be above the 100%. And what contribution rate does that mean we have to pay? So we do that for each employer to arrive at the appropriate contribution rate. So that's the kind of methodology. Now to the bit you're probably most interested in is the actual output itself. So I'll start with the kind of whole funding level and the results that we came up with first. And the reason we produce whole fund results is to basically show at a high level what is the solvency of the fund. Do we have enough money now or do we think we have enough money now? Because all this is obviously based on estimates and assumptions. Do we think we have enough money now to cover the benefits that have been earned up until now? So it's a good check on that to make sure that we're going in the right direction in terms of funding level. It's also a good risk management exercise because we can, as I mentioned earlier, we can kind of look at the risks involved, look at what has impacted the funding level since the last valuation, and look at how the experience has panned out against what we assumed last time around. So that initial work we do is at whole fund level, and then we delve deeper into each individual employer's level, funding level rather. So this chart and this table rather shows the whole fund results. So that's kind of at aggregate level. So last valuation 2019, the fund was 97% funded, and it's improved a bit since then to 100% funded. And I'll come to the reasons behind that shortly. But it is important. That's certainly a good news story that the funding level's improved. But it is important to remember that when it comes to a funding level, that's at one point in time. So that was at the 31st of March, and that does move every day because markets move every day. So your assets move every day, and also the value that you place on the liabilities changes every day because the expectations and the assumptions would change on a daily basis depending on what markets have done as well. So it's a good news story, but important to just remember that that's kind of at one point in time. I'm not going to go through these two tables in a lot of detail. For any accountants amongst you, you might enjoy seeing this. It's a kind of balance sheet basically, and a reconciliation between the last valuation and this valuation of what the funding level has done at whole fund level. And the two green boxes that have been highlighted here have been the main drivers since the last valuation. So on one side, the top green box there, as Neil mentioned earlier, we've had very good investment returns since the last valuation, and that's come through as a kind of an additional £655 million in assets that we didn't assume would happen last time around. But on the other side of the equation, the second green box is showing the impact of that future expectation of inflation. So we're expecting inflation to be higher in the future, And so that has had a kind of impact on the liability side to increase the liabilities by just shy of £450 million. So these are the two main drivers of what's happened since the last valuation, and the returns on the assets have kind of outweighed that increased inflationary impact on the liabilities based on the past service. So that's the reason that there's been a slight improvement in the funding level. Has anyone got any questions on that kind of whole fund level before I move on to talk about more kind of individual employer level?
No, there are no questions, Barry, at the moment.
Okay. So the employer level results, we've shown a couple of charts here. Partly it's really to show the kind of variability of what sits underneath the whole fund level. So at whole fund level, the fund's gone from kind of 97% funding to 100% funding. But the chart on the right here shows the variation underneath the bonnet, if you like, of all the employers underneath. So that kind of aggregate position of being 100% funded is the aggregate of all of these dots. So it's not that everybody underneath is 100% funded. There's a big variation, as you can see, from ones that are not very well funded to ones that are very well funded, and the kind of dark blue dots over towards the right there are the councils, which have a kind of heavier weight, I suppose, towards the overall funding level, because they've got the most assets and the most liabilities. So their funding levels are closest to that kind of whole funding level of 100%. But it's just to kind of to highlight that not every employer is in the same situation. And on the left-hand side, that chart ultimately kind of shows again the variation of how the fund is made up in terms of the employers. So the left hand side shows the councils, which, as you'd imagine, make up a big part of the fund, but there's relatively few of them. So the kind of orange bar on the councils is quite low because there's not that many actual councils in numbers. And then you've got kind of the other end of the extreme is the kind of admission bodies on the right hand side there, which is the kind of contractors I was talking about earlier on, like catering companies, cleaning companies. So there's actually quite a few of them in number. So that's the orange bar. That's why the orange bar is quite high, but they have relatively small liabilities because there tends to be only a few members in each one. So this is to kind of highlight just the importance of actually looking at each individual employer and having an appropriate funding plan for each employer. So the general themes in terms of the results are that the most likely most employers will have seen an improvement in their funding position, so their funding level, and based on the past benefits that have been earned, because those assets have performed very well over the last 3 years. And so that might lead to lower what we call secondary contributions. So that's the element that's largely there to kind of allow for payment for any deficit that's sitting there. But what we call the primary contributions is essentially the cost of future benefits being earned. And those are kind of not related to how well your assets have performed in the past. It's purely what do we see going forward as being a kind of an investment return assumption and how an inflation assumption, and how does that what does that imply the contribution rate needs to be for future benefits. And we are seeing upward pressure, quite a lot of upward pressure on those, purely because of the higher inflation assumption, and the fact that we're expecting inflation to be higher in the future means that the cost of those future benefits is quite a bit higher this time than it was last time. Now, the net impact of those two things, so kind of on the one hand, kind of lower contributions needed to fund any gap in the funding level, and the kind of increased inflationary pressure on the cost of future benefits, that'll vary by employer. So some employers, one will outweigh the other and you'll have a lower contribution rate, and other employers actually it would be more focused on the future service, and actually that going up has meant that you've got an increase in your contribution rate. So it's not all good news for every employer. there are some that will be going up in contribution rates, but there are some that are in a position where they can reduce as well. So it will be a variation between employers. There are other factors. It's not just all about kind of investment return and inflation that impact your results. So the balance between past and future service matters. So you've got you'll have councils which have an awful lot of past service, and so that has quite a big kind of impact. And you'll have maybe academies that don't have so much past service, and it'll be more about the future service cost, because they've not been in the fund that long and their members haven't earned as much benefit, and so it'll be more reliant on that future service potential increase in contribution than perhaps a past service and secondary rate reduction. Membership experience. So the impact on your funding level is all based on your membership. So that can make a big difference from one employer to another. If your members have received higher salary increases or lower salary increases than other employers, then you'll see a different impact. Things such as ill health retirements. If you've had an ill health retirement for one of your members, that can have a big impact as well on your funding level. And then you've got age and gender. So if you've got a group, if your employees are a group of kind of older members rather than younger members, then the cost of those benefits for the older members is higher because you've got less time until they'll be taking them. So you can't rely as much on the investment return you're going to earn because you've got less time to earn that investment return before they have to start being paid those benefits. And then the contributions being paid. So if you've been paying higher contributions, you'll have had a higher funding level improvement than another employer in a different situation. So in summary, funding positions on the whole have improved, but that might vary depending on those various different factors I've just discussed at individual employer level. And that's mostly because of the strong investment returns, more than offsetting the higher inflation expectations. But contribution rates going forward, quite a bit of upward pressure on what we call the primary rate. So that's the future service part of what you pay, and that, as I mentioned earlier, that often makes up 85 to 90% of what an employer is paying. So that can have a big impact, and the overall impact will vary, as I said, between employers. Are there any questions on that before I go on to specifically talk about and kind of talk you through a schedule to kind of just, you've got a bit of more background on that?
I can't see any questions, Barry. Obviously, if anyone wants to come on afterwards and send any questions over to the fund, we'll either answer them ourselves or direct them on to Barry if we can't ask them. Okay, thanks, Barry.
Great. So understanding your results, as I say, the majority of you have hopefully received your results schedule by now. Some of you may not, but it will be coming shortly if not. So what we've done here is we've got a few slides just kind of taking you through the various parts of the schedule. It is reasonably lengthy. It's about 5 or 6 pages long, but the kind of bulk of the information that's probably of most interest is on the first couple of pages.
Barry, can I just jump in? We have got a question. What does a negative secondary rate mean?
Perfect. A negative secondary rate is basically, it will most often be the case if you are over 100% funded that you would have a negative secondary rate. And basically what that's saying is because you are, say you're 110% funded, 115% funded, you may have a secondary rate which says you don't have to pay the full cost of future benefits because you've got a little bit of surplus there that you can use to cover some of that cost. So that's what a negative secondary rate means. It's basically saying if you're in a very good funding position, and normally, to be fair, you'd probably be kind of 115, 120% funded, something like that, then what that negative secondary rate is saying is you can use some of that surplus to pay, essentially cover some of the cost of the future benefits. So that's why, for example, in this screenshot here, this one's got a kind of negative secondary that brings the percentage of pay amount down from the 25% primary rate. So basically that's saying the cost of future benefits is 25%, but actually you can pay a bit less than that, come down to 19.5. Hopefully that answers that.
Thank you for that, Barry.
So just to go into a bit more detail here on this. So this is on page 1 of your schedule. It comes out with the contribution rates. So it's got the primary rate, which I mentioned just now, as that's basically the estimated cost of future benefits. So that's expressed as a percentage of pay. You have an adjustment, so the secondary rate is an adjustment to that primary rate to get you to the total rate that we think is needed to pay. And as I mentioned, typically that'll relate, broadly speaking, to your funding level. So if you're very, very well funded, then so kind of, as I say, about 115, 120% funded, you might see a negative secondary amount. But if there's a gap to be filled, then you'll likely see a positive secondary amount there. And even actually, if you are at the valuation date, you can be in the situation where if you're at the valuation date and you're still over 100% funded, you can still see a positive secondary amount there. And it's because what we're doing is we're projecting to the end of your time horizon and saying, okay, I know you're 105% funded now, but what does it look like you might be in 3, 5, 10 years time? And it based on our projections, and it looks at it at that point in time. So it might well be that you still have a positive secondary even if you are over 100% funded. So the blue box there basically highlights that's essentially the overall total contribution rate that you'll have to pay, and that'll be split. For some employers, it's purely a percentage of payroll amount, and for some of them, it's expressed partly as a monetary amount as well. And so that reflects what's payable over the next 3 years from the 1st of April 2023. The text underneath covers a bit of additional information about there is an administration expense allowance within the contribution rates as well, and also it tells you what your average employee contribution rate is for your specific membership as well.
Just got another question, Barry. That's
yep.
Okay. Mm-hmm. It says, why is the monetary amount the same in both columns on the example?
Because essentially what the total there is the combination of the previous 3 columns. So the percentage amount there, so if we take 31st of March 2024, that row as an example, you've got a primary rate of 25%, you've got a negative 5.5% to take it down to that 19.5%, and then you've got a £382,000 monetary amount in this case as well. So the monetary amount is just the same because there's no adjustment to that in this particular case.
Okay, thank you.
Any more questions on that, or are we safe to move on?
We do have another question.
Okay.
What if you can't afford to pay the increased percentage?
If there are affordability concerns, then that's you definitely want to get into contact with fund officers, and we can have discussions about what isn't doable from your perspective. So it's definitely one to raise with the fund if you think there's an affordability issue.
Yeah, I think that's the case. Get in touch with ourselves if you've got concerns about the results that you've got, and we can have a chat and discuss it further.
Great. Okay. So also on page 1, there is a table that shows some of the things I was discussing earlier. So the kind of the funding target that's been used for you as an employer, the funding time horizon, and the likelihood of achieving the funding target that we've used to calculate your contribution rate. So basically this is saying, in this particular case, we want a 75% chance of you being fully funded at the end of the time horizon, and that's what we've used to work out an appropriate contribution rate. So everybody will have this. It won't be these same numbers for everybody because it depends on your individual circumstances, but it basically is just setting out the parameters we've used to work out your contribution rate. There's a bit of text underneath the box which explains it a bit more as well, but also this is kind of detailed in section 2 of the updated funding strategy statement, in terms of how each employer group is treated from this perspective, and so do refer to that as well as you're looking at your schedule. On page 2, we show the funding level for you as an employer. So in a similar way as the chart, the table earlier of the whole fund position that had moved from 97% funded to 100% funded, you as an individual employer will get the same kind of breakdown as is shown here, based on what's happened since the last valuation. In this particular case, this employer's gone from 95% funded to 101% funded, which is a good news story. But as I mentioned earlier, it's important to remember that's a snapshot at one particular date. It doesn't include future benefits. It's just purely based on what has been earned up until that point in time. So it doesn't impact on what the cost is going forward for future benefits. And it is different from what you disclose in accounts. If you have to disclose under FRS 102 and IAS 19, those numbers would be different. The asset figure would be the same, but the liability number would be different, because under accounting disclosures, we have to use particular assumptions for investment returns that they're actually based on corporate bond yields at the time. Whereas what we're doing when we are valuing the liabilities here for the valuation is we're looking at your actual investment strategy and seeing what kind of return do we think we could achieve on that. But for accounting purposes, you have to use corporate bond yields as the kind of return assumption. So the number would be different on an accounting basis. It's also worth noting, if you're in a pool, such as the parish and town council pools, it will be the pool position that is shown there, not your individual kind of employer position underneath, just to bear that in mind when you look at the schedule. Page 3 details the assumptions we've used, and it shows last times versus this times as well. So the top table covers financial assumptions, and that's the ones that are used to calculate the funding level. They are also specified in Appendix D of the funding strategy statement as well, if you kind of cross-reference those. So it shows how they've differed from the last valuation to this valuation. That middle box is, I mean, that middle box is frightening for me, let alone any of you. It's a lot of technical detail about the life expectancy assumptions, and so that's not something that you really need to pay an awful lot of attention to, because it's a lot of kind of technical detail about the assumptions and how they've been derived. But it's put in there in case, for example, you as an employer want to get some kind of independent advice, then it shows your independent advisor kind of how we've arrived at the life expectancy assumptions. And probably a more useful table at the bottom there in terms of life expectancy is it gives you the average life expectancy from age 65 for all the members in the fund. So that gives you an idea of how long we are assuming people are going to live in the fund beyond age 65.
Barry, we've had a question about the town and parish councils, why they are lumped together on the schedules.
They are lumped together in the schedules because the town and parish council pool is essentially a what we call a kind of funding pool. So the funding level is essentially the same for all members of each pool. At each valuation, we assess them in aggregate and say, right, okay, the overall funding position is X% funded, be it kind of 90, 95, whatever it is, 95% funded, and we say, right, okay, we're treating that as a pool of employers, an aggregated position. We don't treat each individual parish or town council as kind of individual unless they cease. At that point, we then look at their individual positions since the last valuation. So basically, all the parish and town councils within each pool you are in, you are pooled with all those other bodies and have one funding level until the point at which you cease.
Thanks, Barry.
Okay. Page 4 has a summary of the membership data for your particular employer. And again, it shows last valuations versus this valuations. It's quite an interesting view, and you can kind of see how your membership's moved in terms of the employee members, the deferred members, and the pensioners, and indeed the various kind of payroll and pension amounts as well as an average age of your membership as well, which can be quite useful information. Do have a look at that, and do kind of flag anything you think is not the case, if you think there's something wildly different from what you were expecting, because that data is the foundation of your valuation results. That summary of the data is the data that we use to do all the calculations. So that's something that it's important that we get right, because it can make a difference to your results if it's wrong. Page 5 has the kind of that kind of balance sheet reconciliation between the last valuation and this valuation in terms of what's happened for you as an employer. I'm not going to go into an awful lot of detail talking about each individual item on here, but it's kind of the breakdown we do to make sure that we're happy that the results are sensible, more than anything else. And so you'll see various different items. We try and place a value on the impact over the last 3 years, such as salary increases, and kind of how many people have died compared to what we thought, and how many people have left active service compared to what we assumed, and things like that. So it's a lot of detail, but it is useful to get a bit of understanding from your perspective in terms of how things have moved since the last valuation.
Barry, we've got a question about we're a community school and come under Derby City for pension, haven't received the schedule, so will this be sent direct to Derby City? And if we email after this, would we be able to say what the contribution rate is going to be so the budget can be updated? That might be one more for us, is it?
Yes, I hope so.
Yeah, I'm just dropping a reply to that question, but
Yep.
basically, yeah, local authority maintained schools will fall under their city or county council's contribution rate. And either the city or county council, whichever one you fall under, should be in touch with you to confirm that rate very soon.
We can give them a prompt, Heather, that you've asked the question. I think it's the better governance is that it comes directly from them, but yeah, we'll prompt that you've asked us the question and ask them to get in touch. We've also got another question, Barry. What is other member experience?
It's a very good question. But basically, what it is, we try and break down as much as we can a reconciliation from the last valuation to this valuation, and so we split out these elements here that are in the list on that kind of membership experience versus expectations. But there's only a certain amount of granularity we can go into. There will be just kind of membership experience that is not possible to delve deep enough into to quantify, and that's what kind of comes out in that other membership experience. We generally don't expect it to be a very large number compared to the liability figure at the bottom there. So in this case, it's kind of 283 out of 100,727 for this particular employer, which is a very small proportion of the liability. So we generally don't expect it to be a very big number, but one exception to that can be in particular for academies, where the membership movement is quite significant, tends to be between one valuation and the next, so that number can be a little bit higher in comparison to some others, but generally speaking, that number should be quite small relative to the overall liabilities, because we try and break down what the impact is using those rows above it first, to try and make sure we're covering off what's happened since the last valuation.
Thank you. Where would the town council schedule come from? We also need this for next year's budget. Sorry, Christine, which town council is that? Belper Town Council. So that's one of the towns and parish councils, is it?
I think what we'll do
yes,
is...
it is, yes.
Yeah. Steve, have they gone out yet?
Yes, they have gone out. So what we'll do, Christine, we'll make sure that yours has gone out. It might have gone to a different contact to yourself if maybe you've just joined the council recently.
No, I've been here 18 months. I'm the only contact for pension.
Right. In which case we'll check on it and we'll come back to you directly after the meeting if that's okay.
That's fine. Thank you very much for that.
Okay. Cheers. Bye-bye.
Bye-bye.
Okay, thanks. I think that's it on the questions for now, Barry.
Okay, great. Right. So that was kind of taking you through your schedule, just to give you a bit more background. And lastly, I'll cover off the funding strategy statement, which I mentioned earlier. And this has been reviewed as part of this valuation and is reviewed as part of every valuation. And actually was reviewed not too long ago, a year or two ago, because new regulations came in which required some more information to be put into that document. So it was reviewed not that long ago, but has been reviewed again as part of this valuation to make sure it's in as good shape as can be. So what actually is it? The funding strategy statement is essentially the kind of the Bible, if you like, of how employers are treated in the fund from start to finish. So when you come into the fund, how you do that, and whilst you're in the fund, how your contribution rates are calculated, and so on, and then how you would exit the fund as well. So under the regulations for the LGPS fund, sorry, is that a question popped up?
Yeah, I've just seen it, Barry. It says, just double checking that the employee contribution rates on the schedule should be budgeted based on primary percentage of pay or total percentage of pay.
It should be the total. So if I go back to this, you would be, it's your total, it's really the total column that you're most interested in, because that's basically what the fund is expecting to receive from you. So in this case, kind of in that first row of the blue box, the fund would be expecting 19.5% of pay plus £382,000 from this particular employer.
Well, thank you.
Great. So the FSS, funds have to prepare an FSS under the regulations, so that's a good reason to do so. The FSS itself must have regard to the investment strategy statement. So there's an investment strategy statement that sits alongside this as well that the fund has, and so we have to make sure that the funding strategy statement is consistent with that, and in particular that we're using the right kind of assumptions based on the investment strategy of the fund. Must be reviewed regularly, and as I say, we do that every 3 years, or indeed more regularly if there's particular regulation changes. And the changes must be consulted on with employers. So committee kind of generally approve a draft that then goes out to employers for consultation before being finalised. And the idea is this is finalised early next year. And the FSS must be published, so it will be published on the pension fund website. And funds must follow SIPFA guidance in producing this funding strategy statement, and that has been done as part of this review, just to make sure everything's in it that should be in it. So what's actually changed since the one that was produced last year? It looks like there's quite a few things that have changed here, but largely the biggest change is a kind of structural change. So we've tried to make it a bit more user-friendly and practical. I think it was probably about somewhere between 50 and 60 pages long before, and so we've streamlined that a bit, taken out over kind of 20,000 words out of the document to make it a bit more kind of accessible for all the stakeholders, so kind of you as employers, but also kind of committee and board who look at this document as well. It makes it a bit more concise. And another thing that we've done is moved quite a bit of the section that's on cessation flexibilities. We've moved that into the separate cessations policy, which already existed, but what we've done is just move quite a bit of that out of the funding strategy statement and moved it into that separate policy. And there is still a reference within the funding strategy statement that points you towards that document if that's what you're looking for. Another thing that's changed is the time horizon for the longest term employers has been reduced from 19 years to 18 years. The fund's kind of seen this kind of positive performance over the last few years as being a good opportunity to bring that time horizon down a little bit. The stabilisation approach. So this is basically for the longer term and stable employers within the fund. There's a kind of stabilisation mechanism, we call it, which basically says we try and keep the contribution rate stable by not letting them move by more than a certain amount each year, with the idea being that over the long term it all kind of balances out, because you don't increase too much when times are bad, but you don't decrease too much when times are good. And so that has been extended a little bit to allow reductions of up to 1% of pay each year for those employers. Another change is that what we call the low risk exit basis has been updated to be more similar approach to what we use for ongoing employers, in that it uses that risk based 5,000 projections kind of approach, and basically gives a bit more flexibility and a bit less of a kind of cliff edge for the employers that are assessed on that basis, in that we're now using a corridor of kind of, if you cease and you are assessed on this low risk exit basis, if your assets sit within this corridor, then basically there's no debt to be paid, and there's no surplus to come back to you if that was appropriate either. And so this is basically to try and make it a bit less of a kind of cliff edge in terms of you must have this amount of money to leave the fund, and have it in a kind of corridor which makes it a bit easier to target for those employers. Now, the employers that impacts tend to be the ones that leave without leaving a kind of guarantor behind. So if you don't have a guarantee from your from another employer that's staying within the fund, then you'd be assessed on this low risk exit basis in general. And last thing is that we, as Neil touched on earlier, the fund's doing a lot of work on climate risk and climate change, and so we've documented a bit more within the FSS how that's been addressed from a funding perspective. And just to give you a bit of background to that, what's happened is when we were doing a lot of the modelling for the contribution rates, we also looked at various different climate risk scenarios that might pan out over the next 20 years, and basically tested the robustness of the funding strategy against those 3 different scenarios, and you'll be glad to know that the funding strategy is robust in terms of being able to adapt to those different outcomes if they should come to fruition. So there's been a good deal of work done on that as well. So coming back to this same valuation timetable, next kind of steps are finalising the funding strategy statement and all the results to go into the final valuation report, with the contributions becoming payable from the 1st of April. So what do we kind of ask of you? Basically, if you haven't received your schedule already, you should receive it shortly, and when you do, please do read through it, check that the data is correct from your understanding, or if you don't necessarily know all the data points, you just check it's kind of in line with what you might expect. Understand your current funding position and the contribution rate that's due to come into payment from the 1st of April. Do please review the updated funding strategy statement. It's out for consultation, and the fund does want your feedback, and it's good to get feedback in terms of what you think of the document. And do talk to the fund if needed, because that's you're better speaking to the fund now and addressing any particularly affordability issues that were mentioned earlier. Do discuss it with the fund, because all of these rates do need to be signed off in advance of the 31st of March. So do approach the fund as early as possible if there's concerns around that.
Barry, we've just got a couple more questions come through.
Yep.
So the first one, it might be of interest to some of the admission bodies. So thank you for the session. As a smaller employer with 400 employees in total, we no longer take on any work involving LGPS employees due to the risk when our schemes have a tiny number of members. Has there been any take-up of pass-through agreements where the risk is held by the contracting body? Or is this something that is more a theoretical option?
We have seen much more uptake of pass-through as an option, and I think Steve will confirm there's more and more pass-through arrangements in place as time goes by, and it can be very good from a kind of flexibility perspective for both contractors and indeed for councils or whoever is doing the outsourcing. So we are seeing more and more of it, and so we do anticipate that becoming more and more popular as well, just to try and reduce the volatility more than anything for small employers like contractors.
I think one of the big things is for admission bodies who are taking on contracts to be aware is that anything like a pass-through arrangement or agreement should really be covered in the contractual arrangements between the parties. So if you're at a point where you are taking on a contract, then I think it's at that point, or when you first see the tender, to ask the question about whether or not pass-through arrangements are an option.
Yes, absolutely. I'd agree with that, because it gets messy if the kind of the wheels start turning, but that's not been addressed at the outset. So yeah.
More questions. So given the importance of inflation forecasts, why is there an upward increase in predicted rates shown in years 4 and 5 post March 22 valuation?
Is that referring to? I'll see if I can find that chart. I think it's this little hump here, year 4, that's probably being referred to. I think it's just our model kind of takes into account short-term expectations that inflation is higher, but then there also there's this line is trying to basically show the kind of average of 5,000 different versions of what inflation might look like. So there is a little hump in year 4. It's more a kind of consequence of the modelling than anything else. But basically, it's not necessarily expecting a kind of dip and then a jump as much as that's perhaps showing. It's just that there's limited data points that we're showing here, so it's probably not quite as dramatic as that in terms of the actual kind of model that it's showing. But yes, well spotted, but it's more a kind of function of the model than necessarily an expectation there'll be a jump up in year 4.
I don't think there's any more questions at the moment, Barry.
Excellent. I think I'm either nearly done or I am done. Yes. So that was me at the end anyway. So that's grand. I'll stop sharing in case anyone has any final questions.
And having said that, there are some more questions just come through.
Excellent. Okay. Let's have a look.
So one is
the next one was about taking it offline, I think.
Yes, I've contacted the questioner about that, and we're going to take that one up offline. So the next one is a 6% increase in primary rates within the stabilisation mechanism?
The stabilisation mechanism applies to the total rate. So you could see a large increase in the primary rate, but the total rate between kind of one year and the next shouldn't move. So you would see, for example, you might see a 6% jump in the primary rate, but the secondary rate would kind of bring that back down again to within the stabilisation mechanism range.
And there's one more question. Will there be a change in the employee contribution rates?
No, they are set out in legislation, set out in the regulations, so you can't change those unless government decides to change them. So they're set in stone basically. So that's why the kind of the fund has to address any additional cost requirements via either kind of better investment return assumptions or based on increasing employer contribution rates.
Okay, thank you very much. I think that's it, is it, in terms of questions for the moment? Thank you very much for those. That's really helpful. We were going to have a 5-minute break, but being as we're only sort of 20 minutes off finishing at 12, I think we'll crack on if that's all right. Thanks very much, Barry. Really appreciate that. It's been a very helpful explanation. I think particularly that run through the schedule, it was it's really helpful to make people understand what it means to them. Sorry to done that. Steve, are you all right to crack on?
Yeah, I think we're just about ready done.
By 12.
Yeah, we'll try. Okay.
Thank you.
Yeah, so I'm going to just go through a few slides fairly quickly about live topics that are in the LGPS at the moment. And please, if anybody's got any questions as we go, either pop your hand up and somebody will prompt me, or pop a question down the chat. So firstly, I hope you found Barry's presentation really helpful. I found it helpful, and it's one of those really complicated things to get your head around, but it really puts some kind of light on it all. So firstly, on the valuation, so most of you should have your result schedule, or for some of you, you'll get it very soon. So what happens next? Well, the first thing to say is that the results are issued in draft. The reason for that is that the funding strategy statement, which Barry mentioned a few moments ago, has yet to be finally confirmed and approved. It is open for consultation from next week, and we'll be writing to you all, hopefully at some point next week, to say, yeah, the consultation is opened. We'll tell you where you can see a copy of the draft copy of the funding strategy statement, and you'll have right up until the end of January to have a read through it and come up with any comments or questions that you've got about it. If you have any questions or concerns about your draft valuation result, please get in touch with us, and we'll answer your questions as best we can, or have a discussion about rates. If we need Barry's involvement, of course, we'll contact Barry. The funding strategy statement itself, any comments that we get will be reviewed by the administering authority of the pension fund, and that's Derbyshire County Council's Pensions and Investments Committee, and they'll be reviewing all responses to the consultation on the 8th of March next year, with a view to all the rates then being applied from the 1st of April 2023. So that's the most important matter. So if there are no queries about your rate, or if there are no changes to it in the coming weeks, then the rates that you've got or you will get in your schedule will apply, and you should make sure that that's applied from the 1st of February from the 1st of April next year. And then that will take us right through until the next valuation, which is penciled in for 31st of March 2025, at which time we'll be talking about the new rates to apply from the 1st of April 2026 through to the 31st of March 2029, which seems a very, very long time away, but it probably isn't. So in terms of already getting ready for the 2025 valuation, just a couple of things just to be aware of, that it's really helpful if you can keep us up to date at the pension fund with any changes in your organisation. So that's councils or academies who might be outsourcing any services or functions, like, as Barry said, cleaning and catering services, admission bodies having any changes to contracts, extensions to contract length, that sort of thing. And also making sure that we've got accurate data. And as we'll touch on in just a moment, we have a system which we're trying to get all of our employees on, called our iConnect system. And that's the best way of getting secure monthly data across to us. It's absolutely vital that we have accurate data, because valuations rely on up-to-date and accurate information. So if you do have any changes in your organisation like that over the intervening years, please do let us know as soon as you can. So what we're going to do very briefly now is just look at one or two other LGPS matters that are live issues at the moment. Some you might be aware of, some you might not be aware of. So that we're going to touch on data submission developments, we're going to touch on member engagement, the cost of living crisis, and just a little bit about outsourcings. So the first one, we mentioned a moment, the iConnect system. So what is it? It's our secure platform for monthly data submissions. It's hosted by our pension software provider. It's called Altair. It's run by an organisation called Haywoods. See their logo in the top right hand corner there, and it's now the required method of data submission. You might remember that a few months ago we opened a consultation about some changes to the pension administration strategy of the fund, and that strategy is the kind of document that sets out the relationship between the fund and all the employers, yourselves. One of the main things about that change in the strategy was the fact that it made the required method of data submission the iConnect method. We've already got over 225 employers who are already submitting data live to us through iConnect, but we've still got a few to go, and we're hoping that all of those that aren't yet on iConnect will get it implemented over the next few months. Got to make you aware that if we do have any employers that don't engage with us on this, then there will be charges for non-compliance from 2023. The reason for that non-compliance is to cover the costs of us having to maintain the year-end return process. So please, if you haven't got in contact with us yet about implementing the iConnect system, please get in contact with us as soon as you can. When you get the slides, you'll be able to see that email address there, and that's the team that are dealing with the implementation programme. There are benefits for the fund and the employer in you implementing iConnect, so we'll just touch on one or two of the benefits for the employer. So you can see there it supports multiple interfaces. So what does that mean? So that means that there are different options which cover all employer sizes, from an automated file submission for the larger employers to a more manual option for the smaller employees who've maybe just got a handful of scheme members. Also reduces the need for technical knowledge. So it's quite a simple spreadsheet format that's used. It doesn't need a massive amount of technical knowledge to get the correct data across to us. It takes up a lot less resource, especially for the bigger employers. It's a much simpler method, and it eliminates a lot of the manual processes, such as a lot of our manual forms, things like the status form, the changes forms. And of course, that year-end return that you've been completing for us manually every April. So once you're on iConnect, there will be no more year-end returns. So they're just some of the main benefits for the employers. So if you're not on it yet, please get in touch with us for two reasons. One, because there are a lot of benefits, and two, to avoid some charges. Something else that you might be aware of that's happening at the minute is preparations for something called a pensions dashboard. And what this is a national initiative, and the aim is set out in this quote from the programme lead. So I'll just read it. It says, pensions dashboards will enable individuals to access their pension information online, securely and all in one place, thereby supporting better planning for retirement and growing financial well-being. So what does all that mean? So it means that individuals will be able to log on to a national pensions dashboard, and they'll be able to interact with their retirement savings. Now, there are lots of people who maybe stay with one employer throughout their working life. But there are more and more people these days who have lots and lots of different employers, probably paying to lots and lots of different pension schemes. And it will be a really useful initiative to be able to just go to one place and basically see what they've got as their pension build up. So all of their pension entitlements, including the state pension, will be online and all in one place. So in terms of the LGPS and all the other public service pension schemes like the Teachers Pension Scheme and the NHS Pension Scheme, we've all been told that we must be ready by the end of September 2024 to be able to provide data and be in a position to put data onto the dashboard by the 1st of April 2025. So they're the dates at the moment, and they're the dates that we're working towards. One of the requirements is going to be that data will be expected to be on the dashboard up to a certain date, and it's likely to mean that submitting data through a portal such as iConnect is likely to become mandatory for employers. So that's another reason to get on board with iConnect as soon as you can, because once we get into the National Dashboard Programme becoming live for the LGPS, it's likely to be a requirement. And just one last thing on the dashboard programme, you might start seeing this over the next couple of years, something called the Pay Your Pension Some Attention campaign. And the aim of that is to engage more interest and make pensions a talking point amongst individuals. So if you pop in Pay Your Pension Some Attention into Google, you'll be able to see some of the resources that the campaign's already got there running. One of the next initiatives is about member engagement, and this is our My Pension Online portal. It's what's known as a member self-service portal. It's very easy to sign up to. Hopefully, if you're eligible for the LGPS and you're paying into it, you've already signed up. We've currently got over 19,000 members already signed up, which is really good for saying that it's only been live for about 18 months. What can members do on My Pension Online? So I won't go through all of these because we're fairly short on time, but you'll be able to see things like access your latest annual benefit statements on there. You'll be able to see any death grant nominations that you've made. You'll be able to update some of your own personal information. You'll be able to use a really clever online calculator where you can pop in different potential retirement dates and see what your pension estimate is looking like. It's a very useful tool. That's proving quite popular. And the portal is going to develop, and we'll be interacting with members more and more through My Pension Online. And where members have registered, we'll be contacting them more electronically rather than sending letters through the post. So it's there now, ready. Please sign up if you haven't. And it's going to be basically the focus of our interaction with members going forward. So how can employers help with this? How can you guys at the employers help? Well, you can encourage your employees to sign up. We really need employers' help to encourage all the members who haven't yet taken the steps to register, to go through the registration process and get signed up. We've got various resources available on our pension fund website that you can use, things that you can use on things like staff newsletters, emails, intranet pages, or any posters and leaflets that you could pop up in offices or corridors at work. There's a link on the slide where you can go directly to our resources page, and you'll be able to see what's there. So if there are any other resources that you think might be useful, please give us a call. We can chat about it and see if we can help you with those. So please encourage your members if they've not already signed up to do so. Just a couple of other points that we'll touch on. This one is a little slide about the cost of living crisis. You might think, well, what's that got to do with pensions? It means that more members are looking at their pension and they may be considering opting out because they might be considering that pension payment from their pay every month. They might be considering that it's an unnecessary payment. And that comes from a lack of awareness about their pension benefits and about what the benefits that they've got in being in a pension scheme. Also, at times like this, there's an increase in pension scams, where people might be contacted by people saying, look, leave your pension scheme, transfer it all over to us, and we'll make it a lot better for you. That is a scam. So it's very useful if people can be warned about things like that. So what can you do about this? So again, it's something where you can actually be quite proactive with this. So you can highlight awareness of pension benefits. You can signpost your scheme members to our own website, derbyshirepensionfund.org.uk, or there's a specific national LGPS member website, lgpsmember.org, and that there are actually some frequently asked questions on there about the cost of living crisis. I think actually if you click on lgpsmember.org, I think it takes you straight to those frequently asked questions. There is flexibility in the LGPS for people who maybe are thinking about opting out, really are struggling to afford their contributions, but there's a midway option. There's something called the 50-50 option, which you might have heard of. What this effectively does, it allows people to pay half of their main contribution into the pension fund. For that, they get half of the benefit that they get in the full scheme, but it does maintain their membership of the scheme. Some important factors like ill health benefits, etc., things like that, are completely unaffected. It's important to note that employers still actually do contribute the full rate. So employers don't contribute 50%. They'll still have to contribute their full contribution level if one of their members does move to the 50-50 option. But it's an option there for people who really are struggling, and they can use it as a temporary option while they're struggling, and they can go back into the main scheme at any point in time. You can also warn your scheme members about the increase in pension scams, just so they're aware that if anybody does cold call them about their pension, it's very likely to be a scam. And we've got a page on our website about scams. So again, please highlight that to people. Just one more point to talk about briefly, so we're running out of time. So outsourcing. So if you're thinking your employer about outsourcing any services or functions, and if that is going to involve the transfer of any of your employees via the TUPE process, please let us know as soon as you can. Pension members do have the right to have their pension protected if they're being compulsorily transferred to an external provider. So please let us know about it. It's quite a complex process. We'll work through it with you. We'll talk through it with both you as the letting employer and of course with whoever your external provider is. They'll have to become something called an admission body in the fund to enable the members to retain their membership. So it's important that you get to give us that information as soon as you can if you're going through that process. Best of all, if you can get LGPS information in the tender, so all the bidders know what they're coming into, know what costs they're going to be, that's really helpful from the start. There are various options that can be looked at. In fact, it was mentioned in one of the questions a few moments ago about that there are more cases where the letting employer who is letting the service are looking at offering pass-through arrangements, where that means that the employer is taking on more of the pension risk, and it makes it a much simpler process for the bidders and the external providers to take on, and with potential less cost. But please, as we said a moment ago, please inform us about any of these as soon as you possibly can, and we'll work through them with you.
We've just had a question. I think you might just have answered that. If we TUPE staff from a local authority service into the trust, do we need to inform you too, or will this be covered with starter forms?
Transferred into the trust?
Yeah.
did you say? So that
Yes.
is that we're talking about a multi-academy trust, I imagine there.
I presume so.
Yeah. So multi-academy trusts operate academies who are what we call scheduled employers in the pension fund. So any people who are transferred into a trust or a scheduled employer in the fund automatically become eligible for membership of the scheme, and that doesn't require any admission body status at all. Don't know if that helps. Hopefully it does. If you've got any further questions about that issue, please come back to us after the meeting and we can talk about it further. Just briefly, if you have any kind of questions or concerns about other LGPS matters, please contact us with your questions. We're here to help, we're here to support. We can provide training if needed for your staff who are kind of involved in undertaking your LGPS responsibilities. If you add employee training into the search bar on our website, you'll be able to go straight to a page which takes you to some information about some of the training options that we can provide. But if there's anything that you think might be useful that isn't mentioned there, please let us know. And any questions? I think we're just about on 12 o'clock.
Almost. Yep. Well, thank you very much indeed, Steve. I don't think we have any more questions at the minute. So thank you very much, everyone, for attending this morning. Thank you to all the presenters and Steve and his team for sorting out all the logistics of the meeting. Hope you found it a useful session. If you've got any follow-up questions, please get in touch with either Steve or I. Take a look at the updated funding strategy statement when it's circulated, and provide us with any feedback to the consultation if you've got any comments to make. And finally, please can you fill in your feedback forms when we circulate them. But thank you very much, everyone, for attending today. 1 minute to spare.
Slides? Will we be able to access the slides, Dawn?
We're going to circulate the slides, I think. Did you say, Steve?
Yes, we are. We'll circulate the
Brilliant.
slides so
Yeah.
everybody will be able to see them. Yeah, I think we've just got a hand up there.
Oh, that was me. Sorry.
Oh, that was you. Oh, sorry. Okay.
Sorry, Steve.
Okay.
No worries. Okay. All right. Well, good to see everyone. Thank you very much for attending.
Thank you, everyone.
Lovely. Thank you.
Thank you.
Bye.
Bye.
Thank you.